Between 1929 and 1933, the United States experienced the worst financial collapse in its history. 25% unemployment, over 9,000 banks failed, the life savings of millions of ordinary Americans erased in months. And yet, documented in congressional testimony, Federal Reserve records, and the oral histories of survivors, 5 specific assets came through that collapse intact. Some of the people who held them came out wealthier than they went in. Liquidity. This video documents all 5, what they were, who held them, and what the forensic record of America's worst financial crisis tells us about every collapse that has followed since. By the end of 1932, the United States had been in economic freefall for 3 years. Unemployment had climbed from 3% to nearly 25%, and in cities like Toledo, Ohio, it reached 80%. The Federal Reserve, the institution specifically designed to prevent financial panics, responded by raising interest rates and allowing the money supply to fall nearly 30%. It made everything worse. Against that backdrop, here is what 5 specific assets did while everything else was failing. In the summer of 1929, a 35-year-old investor named Floyd Odlum became uneasy about the market's trajectory. He had built a $40,000 initial investment into a substantial fund over 6 years. That summer, he sold half his portfolio and raised cash. When October came, he was sitting on $14 million while the rest of the market was being destroyed by margin calls. Between 1930 and 1933, Odlum bought 22 failing investment trusts, purchasing them at prices as low as 60 cents on the dollar from people who had no choice but to sell. By 1933, his company was the largest investment trust in America. His colleagues called him 50 Cent Odlum. In a deflation, when prices fall across the entire economy, the value of money rises every month. The person holding the cash is not simply waiting. They are watching the purchasing power of every dollar they hold increase. And at the bottom of a deflationary collapse, they're the only person in the room with the ability to act. Everyone else is defending. Odlum did not predict the crash. He simply made sure that when extraordinary assets came to a market at impossible prices, he was the only person in the room who could buy them. Liquidity is not a passive position. In a deflation, it is the most powerful position available. But Odlum's liquidity didn't let him act. Asset number 2 is about something different. The legal architecture that determined which of his wealth survived, regardless of what happened to him personally. Joseph Kennedy entered 1929 with approximately $4 million. By 1935, he had approximately $180 million. He had sold his stock positions before the crash, made additional money during the decline, consolidated film distribution rights in Hollywood, and bought import contracts for Scotch whiskey as Prohibition ended. Then he bought investment-grade real estate at Depression prices. Assets with intrinsic productive value, not paper promises. But here's what the history books consistently underweight about Kennedy. Before the crash, he had established million-dollar trusts for each of his children. Those trusts were legally separate from his trading positions. Whatever happened to Kennedy personally, whatever risks he took, whatever positions went wrong, those assets were protected by legal structure, not by luck or foresight. Kennedy later described his method in 3 words: facts, no sentiment, timing. But the structural lesson underneath it is simpler still. The money he needed to preserve was not in the same legal container as the money he was willing to lose. In every financial crisis this channel has documented, Rome, Weimar, Argentina, the Depression, the people who preserved wealth across generations did not do it through investment skill alone. They did it through legal architecture. Structure protects what strategy cannot. 2 down, 3 left. Asset 3 is the one that will surprise you most, because in a financial collapse, most people expect it to fail. The documented records show the opposite. In every video this channel has produced, the asset that survives a crisis is a hard asset. Land, gold, skills, physical things. The Great Depression is the exception that proves why context always matters. The Depression was not an inflation, it was a deflation. Prices falling, money becoming more valuable every month, and in a deflation, the mechanism that destroys bonds in an inflation runs in reverse. The United States Treasury bond, paying a fixed 3% interest in 1930, paid the same 3% in 1932. But by 1932, those dollars bought significantly more than they had in 1930. The real return on that bond had increased every single month as prices fell around it. The people who held high-grade government and corporate bonds from solvent issuers did not make fortunes, but they did not lose their wealth either. In a decade that destroyed most financial assets, that was an extraordinary outcome. One warning that the record demands equally: not all bonds survive. Samuel Insull's bondholders lost everything when his utility empire collapsed. The distinction that mattered was credit quality. Treasury bonds and high-grade issues held. Over-leveraged corporate debt defaulted at scale. The Great Depression did not disprove the principle that hard assets survive a crisis. It demonstrated something more precise. The asset that survives depends entirely on the type of crisis. In an inflation, bonds are destroyed and hard assets win. In a deflation, the mechanism reverses. The historical record rewards the investor who understands which crisis they are inside. 5 assets. One of the most documented financial collapses in history. The same forensic pattern every time. Keep that in mind for what comes next. The next video covers the assets that go to zero in a real collapse, including 2 that almost every financial advisor will tell you are the safest things you can own. Subscribe now so you can see when it drops. On January 4th, 1933, a federal marshal arrived at a farm in Madison County, Nebraska with a foreclosure order. The farm had been in the family for 22 years. Corn was selling for 8 cents a bushel, less than the cost of harvesting it. The math had stopped working, and no amount of effort could change the math. On the day of the auction, 5,000 farmers showed up, not to buy, to make sure nobody else did. When the auctioneer called for bids on the farm equipment, a neighbor bid 5 cents. On the livestock, another bid 3 cents. On the land itself, someone bid $1. Nobody bid against them. Total proceeds from the auction, $5.35. The family got their farm back. This was not an isolated incident. It happened across the Farm Belt hundreds of times in 1932 and 1933. These events were called penny auctions, organized, coordinated, and backed by the implicit threat of collective auction. The academic literature and Depression survival documents the same structural finding across every account. People with strong community networks, real relationships with neighbors, religious institutions, extended family, had access to resources, information, and mutual aid that isolated individuals did not. This is not sentiment, it is structural. Your network is a financial asset. The Depression proved it with a precision that economic theory cannot match. When the formal financial structure failed, the penny auction farmers built a parallel one that operated outside the rules the formal structure was using to destroy them. In every financial crisis this channel has documented, that parallel structure exists. The question is always the same: how many people are positioned to participate in it before they need it? The Depression destroyed financial assets with extraordinary efficiency, but it did not destroy the value of a skill that people needed regardless of what the economy was doing. Doctors still had patients, lawyers still had clients, engineers still had projects, teachers still had classrooms, even when salaries were delayed or paid in scrip. Studs Terkel's oral history interviews with Depression survivors return to this finding consistently. The professionals and the family were the ones who kept the extended network fed. Not because they were wealthy, many had their savings wiped out like everyone else, but because their income, however reduced, never went to zero. In 1931, 5,000 Chicago school teachers were owed $30 million, 10 months of unpaid salary. They stormed the city's major banks in protest. The teachers were owed $30 million. One bank had received $90 million in emergency government funds. In a single night, negotiated at 1 in the morning, the teachers were still there the following Monday, in their classrooms, teaching. Their skill had not been canceled. The Depression erased the normal value of almost every financial asset it touched. It could not erase the value of a skill that kept human beings alive, educated, and functioning. That asset did not appear on any balance sheet. It survived every wave of bank closures, every deflation spiral, and every policy failure intact. In 2002, Federal Reserve Chairman Ben Bernanke gave a speech at Milton Friedman's 90th birthday dinner. He acknowledged what the historical record had long documented. On behalf of the Federal Reserve, he said directly, "We did it. We're sorry. We will not do it again." The institution specifically designed to prevent financial crises had caused the worst one in American history. The 5 assets that survived the Depression did not survive because the institution recovered. They survived because they did not depend on it. So here is what the forensic record of America's worst financial collapse actually shows. Liquidity, the only asset that lets you act when everyone else is being forced to sell. Legal asset separation, the structural architecture that protects what strategy alone cannot. High-grade bonds, the one financial asset that appreciated in a deflation while everything around it collapsed. Community networks, the a parallel structure that functioned when the formal one failed, and irreplaceable skills, the asset that deflation could not reach, reduce, or cancel. 5 assets. One principle behind all of them. The people who positioned themselves to survive the Great Depression did not do it by predicting what the government would do. They positioned themselves to survive regardless of what the government did, by holding assets that did not require government competence to retain their value. Floyd Odlum did not know the crash was coming. He simply made sure that when it did, when extraordinary assets came to market at impossible prices, he was the only person in the room who could act. The Depression did not destroy wealth. It transferred it from the unprepared to the positioned, from the people who waited for the system to work to the people who had stopped waiting. Of these 5 assets, which one do you think most people are currently missing from their own position? Leave it in the comments. Answers across this audience are consistently more revealing than people expect. Subscribe. Every video on this channel is built from the forensic record of what actually happened, not what people believed would happen, and the systems they trusted stopped working. Next, the assets that go to zero in a real collapse, including 2 that almost every financial advisor will tell you are the safest things you can own. History has the answers. I'll show you where to look.